If you do that, you create something that I call emotional retention. And I think emotional retention is the retention that is the most sticky, the hardest one to compete with, because you can have retention just based off your utility and your features you provide. That's fine, that's good, and like, if that's good retention, like, go for it. But emotional retention is the one where you're not just with the company because of the utility, you're with the company because of the emotional connection, the emotional bond that you have with the company.
Hello, everyone, and welcome to Fintech Leaders. Coming to you from New York City, I'm your host, Miguel Armaza, and I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the US, Canada, and Latin America. If you enjoyed this conversation, I invite you to leave a review on Apple Podcasts, Spotify, or wherever you get your show so more people can learn about fintech leaders. Today, I stopped by Public.com's TriBeCa headquarters for a conversation with Leif Abraham, co-founder and co-CEO of Public.com, an investing platform for equities, fixed income, and alternative assets. Founded in 2019, Public now serves over 3 million customers and has raised hundreds of millions of dollars from investors like Greycroft, Accel, Lakestar, Tiger Global, and many more. We discuss how Leif launched his first internet company as a teenager from his room in Hamburg, Germany, the importance of building a customer fan base and the concept of emotional retention, international expansion, and why bonds are definitely back, building Public's app as a mainstream window to the markets, startup founder advice, and just a lot more. Leif, thank you for opening your doors of Public.com's office. Love your building, your office. How did you land in like this specific TriBeCa building?
So in, I think, November 2020, we basically were like, okay, we would assume people come back to the office. That was like pre-vaccines and whatnot, right? And so we just like started looking around. We hired a new BD guy at the time. He was one of the first employees at Notel. And so he just like knew very well, just like the real estate, market in New York. He knew all the brokers, all of the, people that you kind of need to know to basically get this done. And we were like, okay, so your first job before you're going to land some, partnership deals for us and stuff is going to be, you're going to find us an office. He was nice enough to do that. He's, by the way, also an incredible negotiator. Ron Zori is his name. So he's also now running a fund, by the way. He basically like just ran around and looked for spaces. And we stumbled over this one. And it needed a little bit of work, but we got an incredible deal because we basically really just like picked this at the bottom where like no one was thinking about office space in any regard. And so we got an incredible deal, and then also it was like, 2 years and then another 2 years extensions on pretty much the same terms and stuff. And so, so since then we have been in the space, this floor and then another floor up there. I will show you afterwards.
That's amazing.
It looks like a jungle. That's like the interior design hack. Just put plants everywhere. It's going to look amazing.
Q4 2020, Q1 2021, just historic lows for New York real estate. So congrats. But you're not a New York, you're a transplant. I guess now you are basically a New Yorker, but where did you come from before? You have a bit of a European accent, if I'm not wrong.
Oh, a little of an accent. It's a beautiful German accent. So I grew up in Hamburg, Germany, moved to the US in 2008. And so I landed in August 2008, right before the crash, so to say.
Nice.
And then I was first in Boulder, Colorado for like a year and a half. There's an ad agency there. Don't tell anyone. I'm saying this on a podcast, but like some like dark agency history there. And then moved to New York, spent like a year and a half in San Francisco too, and then back to New York. New York is still the best.
Yeah. And when did you start to build, right? To build companies? Because this is not your first one.
A little bit in and out. So the first thing I've built was, so to say, out of my kids' room, which was a website for video games. And because that's what you do when you're a child, you play video games. And through that, I stumbled over like affiliate marketing and stuff. And so I kind of just figured out like, oh, if you embed this ad in your website and someone clicks on it, you can make some money with it. So I kind of fell down this rabbit hole of just figuring out basically ways to make money on the internet. And I had a quite lucky hand with that. So it was, I think it was like 15, 16 at the time. I started to, form measures at that point in time, like make decent amounts of money. And so I started funding fan sites for video games because they were run by, kids like myself or like out of their kids' rooms. And at the time, like servers were super expensive, right? AWS was non-existent. This is like 2002, 3, right?
So you're subsidizing this website.
And so like I was basically then like, paying for the expenses, and in exchange I was getting the rights of all the kind of ad placements, and basically turned that into like an ad network for gaming in Germany, which was like the second largest at the time. But I was literally a child. So like every contract I was signing at the time was basically not really valid because I wasn't even 18 yet. And so on. So I did a bunch of stuff like that and a bunch of other little like projects, around that. And then, ended up basically being like, like a digital agency and stuff and so on. And then got back into it when I was in the US. And, one of the things that a friend of mine and I did, the guy that I moved to the US with together, we always like worked together as like a team and, agency world and stuff. And then what we did was like we wrote this book in 2009, 10 or so. But obviously no one knew us and whatnot. So we created this thing called Pay the Tweet, where it's like you click a button to like tweet about the book, which then kind of has like viral effect. And that went completely viral at nuts. And like, Mitt Romney used it when he ran for president. Sorry about that. Nothing happened. So all fine. But, and, every major record label used it to like give kind of songs away and stuff. So that kind of thing just blew up organically. And then there was like a little bit this crossroads of like, you're going to quit your job to try to make that a company. You're going to let it just have a slow death or so on. And then we sold that to another company builder in Germany. And that was like the first kind of forte into that. And then before public, I did a freelancing software called Anco. It's like, invoicing, payments, task management, all that kind of stuff. And sold that to Fiverr.
I saw that. Yeah. But I guess all those businesses that you have described, they are not heavily regulated. And public.com definitely is, right? I mean, aside from the obvious that you have to pay attention to regulation, how does that change the entrepreneurial experience?
I don't know if it changes that much, to be quite honest. I think, it's obviously, it's just constraints you have to obviously work with. But in our case, I think when it comes to financial services specifically, this mantra of move fast and break things just doesn't work because you deal with people's money. And even when you're a financial service, like things like product health are so much more important, because when you open the app and you see wrong numbers, you're not going to trust this app anymore. And so I think there's just a sense of, doing things, so to say, the more proper way, and compliance just being part of that. I think it's just ingrained as soon as you deal with people's money.
And so why public? Tell us a bit about the story of why decide to launch a fintech.
So my co-founder Yannick was deep in fintech for a while, right? He ran a trading app out of the UK called Tradable, which he sold as well. And we were both at this crossroads of having sold our companies, figuring out what to do next. And basically one of the core insights that happened was really the sense of that if you looked around of why people didn't actively invest in the markets, one of the main reasons was really this like psychological barrier of thinking it's not for you. And so it wasn't really pricing, it wasn't really commissions and so on. It was really more the sense of, I'm not a finance person, I don't know how this goes, therefore I'm not even going to try. And we found that pretty interesting as a, kind of core insight. And it even was the same for me. Like I didn't actively invest until after I was like 30 years old and I had like a little bit of money saved up and stuff, And I would argue that that's the case for most people. And, other outside of like the 401k or something like that, right? And so what we then recognized is that there were basically these like two major barriers. Was basically the sense of just like portfolio construction and basically therefore the ability to buy anything fractionalized. And so, at that time, Amazon was a $2,000 stock, the average, the like median average savings account in the US is like $2,500 or so, I believe. And so it's like very hard to like really build a portfolio, in that regard. And so just that, giving people the ability to just buy any stuff with any amount of money was like the kind of like structural barrier. And then the psychological barrier was really the sense of seeing other people like you invest in the markets as well. And that's really where the social angle also came from a perspective of, as you come into the experience, if you see people like yourself and how they think about it, and you're able to exchange, thoughts and ideas with them, that will make you much more, comfortable, but also much more confident, because you will recognize that it's not necessarily rocket science.
What came first, the name of the company or the fact that you got the domain public?
A little bit. I mean, the name came first because that's when we obviously then looked out for the domain. But we obviously looked for names that were potentially able to acquire domains as well. And I'm a little bit of a domain nerd. I have a bunch of wacko domains in my portfolio. I'm wasting money on that every year.
You think of a great name and you just buy the domain
immediately. Exactly. It's one of those addictions. Exactly. And but long story short, we had this one domain broker guy basically who helped us, structure that deal. And so we were able to get that done. I think we transferred the domain 2 days before launch or so. So it literally, we had another domain already bought, which I think was hellopuppet.com or something. And then literally 2 days before launch, we actually closed it all, got it transferred, had the DNS record straight. And then it was off to the races.
And so what have you learned over the last, how many years have you been live for?
Yeah, so we launched in September of 19.
Yeah.
And so, close to 3.5 years now.
Yeah, yeah. And what have been the biggest learnings? Because you started pre-pandemic, you went through the pandemic where I understand you had, just insane growth. And now we're calling a post-pandemic world where, of course, things have changed a little bit. So what have been kind of some of the key learnings?
So first off, we obviously were immediately kind of falling into a storm around retail investing. And so, there was, obviously also, some, just market dynamics attached to, why we're able to tap into certain growth. We always say there was luck involved, but luck favors the prepared as well. And so you got to prepare to also, take advantage of these situations. But if you think of the different years, basically, right, 2021, you had COVID, sports arenas were closed. The stock market was the only arena that was still open. People wanted to rally for something. Sports betting was off even. And so there was a lot of speculation happening and everything was pointing up to the right, in most cases. And so that obviously created that first kind of wave and, interest. And then the second really came in 2021 with GameStop. So you can think of it as 2020 COVID stocks, 2021 meme stocks, and kind of meme coins as well with, Dogecoin rally, things like that. And so what we've really seen is that the TAM expansion and, the kind of greater adoption of people participating in the markets is accelerated through market events. And in the past, these market events have been driven by speculation because it was the tail end of a bull market and so on. Then though, what we have seen within public is that people might come in through one of these market events, also because for some people it's fun, for some people it's community driven, they want to feel like they're part of something, which you specifically see around things like meme stocks, for example. But then they actually build the literacy as they come to the experience, and they end up building portfolios that might suddenly have SPY in it and, learn about ETFs and learn about other yield-yielding products and so on. And that's really what we've seen of that these market events can be great, just catalysts for just people starting their investing journeys. And even though it might start very speculative, it doesn't mean that they're going to, stay in that mindset. And so if you now fast forward into 2023, you could argue that the market event that's happening right now is in T-bills. And, because suddenly yield is back, it's, something that hasn't been around for, 15 years roughly or so on. And, everyone is kind of re-educating themselves about how do bonds work, right? What are T-bills? What are maturity dates, et cetera, et cetera, et cetera. And so we recently launched treasury accounts, which basically makes it easy for people to invest in T-bills, daily liquidity, automatic rollovers, things like that. And so kind of a comparison to, as an alternative to a high yield savings account with a higher yield because it's T-bills. But what you've basically seen is that now that has a market event and a lot of the retail interest suddenly flows into that. And so you've seen really how also just from a, education perspective on retail, you see how people have really flowed from, meme stocks to T-bills, and you see how market events and these, economic cycles are also these forcing functions for people to educate themselves. And I think that's what we're seeing a lot.
So in a way, what you're saying is, it's easy to get people on the way up for equities, but after the fact, it's part of it for keeping people in the market is offering the right products, once the market has cooled. Is there something else to that, aside from having a good diversified product suite and offering education? What else have you learned about the psychology of investors in the last, call it, year since, we've got away from peaks?
We often talk about, for public specifically, that we want to be the window to the markets for people. And if you look at, even just from a pure media perspective, how people have, followed the markets in the past, you're thinking about Wall Street Journal, you're thinking about CNBC, at Bloomberg, et cetera, et cetera. These are all still fairly sophisticated publications, you'll say. And what we've really done a lot of work in is that you don't just go to public to trade, you go to public because it's your window to the markets. And so on the app, right, we have these public live shows for like multiple times a day. You have this like audio, style shows you can listen into. We have like The Open, which is like our, 15-minute version of like a Squawk Box, right? And like breaking news or like earnings call breakdowns, right? Then you have the social angle to it where you can follow other investors, see what they're doing, see what they talk about. And then you also have things like, why is it moving cards? So like if a chart moves, in one direction or the other, very quickly, we have this little context card that tells you of like, why likely is the stock moving so dramatically right now. And so, which really then creates this behavior where it's not just about, hey, I want to make a trade right now, but it's this behavior of like, hey, what's happening in the markets? And that is really, then also what creates context for people, what educates them over time, what makes them more comfortable. But it also can, for example, help things like panic selling, right? Of, if you open up your app and it's just a red line that points down to the right, it's very easy to also feel unease about it and, make potentially, irrational moves very quickly. But if you have the context around it, you can see how other people, digest what's happening in the markets right now, et cetera, that those things, really help people to kind of make more informed and just like better investing decisions for themselves as well. And so that's where we see really the sense of, that's like the context, creating, so to say, more healthy behaviors.
So bonds are back, right?
Bonds are back. Bonds are cool again.
What's, grandparents were right. So tell me, what's the experience like, launching treasuries? Is this something that the public was demanding before you launched it? And what's been the response like? Yeah,
so we are obviously still a very young company, right? So we are 3.5 years on market. And so if we look at ourselves, we believe we're still far away of, the full product suite of what we believe public should be. And so we're still in the game of adding new asset classes, adding new features, all the time. And as part of that, we're also, it's also a little bit, our job then, even just for the success of the company, even to try to predict a little bit, what will be, the highest impact next, asset class or feature to launch and so on. And as soon as rates start to go up and we were kind of like looking at our roadmap and be like what to prioritize with other things, it became very clear to us that as yield comes back, that a T-bill offering or just a bonds offering in general, will be something that will likely just have a lot of product market fit for the time, right? And it's a little bit like you want to tap into the zeitgeist that's there at the moment because, again, market events are good for us in the sense that they drive a lot of organic interest. And so, if you can capitalize on these market events through different asset classes you have, through the features you have, that basically feeds everything good in the experience. And so that's why, we've obviously worked on this for a little while now, but kind of timed it, hopefully quite well so far, at least, considering that, likely rates will keep going up, I would assume.
And, when you, as a company, let's talk a bit internally about your team. When you decide, to go ahead with some sort of product offering, in this case, treasuries, bonds, how does that machinery work internally? Maybe tell us about, how the sausage gets done, because, we have a good number of aspiring founders or founders tuning in, also a lot of operators. So it'll be good to learn, how you guys develop internally.
So obviously at this stage, like we have a pod structure internally, right? We have specific product engineering teams that have specific domain expertises and responsibilities. And depending on what those features are, they will land with certain people, right? The way we look at the roadmap is though through mostly the sense of products and levers. And so products, you can think of the things that will generate revenue for us, right? It's a products on the shelf that we tend to sell to customers, which in most cases is related to asset classes, but it could also be things like, the premium subscription offering and so on. And then levers are the things that help us grow interest and, just grow, adoption of these products. That can be, in our case, related to flows, because again, AUM and, having more dollars in the app, feeds into monetization of different asset classes. That can mean things like conversion optimization. That can mean things like the ability to move money from different sources in and out of the app and things like that. And so that's roughly how we think about it in terms of like product and levers. And in most cases, you can think of like most product parts will work on the products. And then we have, growth part and so on that will mostly focus on things like levers. And then those two are always in tandem. And, from a prioritization perspective, we just try to figure out, as much as possible to obviously, launch these like in sequences that, that drives the most impact.
And given your European background, obviously, did you ever consider building public in Europe?
So we announced international expansion. And so there's a few countries that are coming soon, which we'll announce very soon. And so that will happen. Like we have this little, theory, even just for what the company is built around, is that we truly believe there's going to be 300 million people with an investing app on the home screen between the US and Europe. And what that means is basically you can think of that as like two major phases, right? The first phase is be part and drive as much of the TAM expansion so that we get a bite from that apple, right? And that's where launching in new markets comes in. That's where, adding more asset classes that drives more organic growth, et cetera, and just like growing the general retail investor user base, right? That's like, you think of that as like phase one. Phase two is really the sense of the closer you get to the reality that you will have, 300 million people with an investing app on the home screen. And therefore, the closer you get to the reality where just retail and just most adults are in some way actively participating in the markets, the more all participants around the markets have to adapt to that reality. And that falls into how do public companies interact with retail investors, that falls into ETF issuers, that falls into potentially financial advisors at some point, that falls into, media companies, creators, and so on. Because again, take the media example, right? CNBC might not necessarily be a mainstream business markets news. It might still be a touch too sophisticated from its format, from, the type of guests that are going on and so on. And so, there will be a point, and that's partially also what we're building, obviously public life and so on, where, there has to be like a mainstream, version of that, truly, everyone can actually consume and understand, can be that translating layer for the broad kind of mainstream retail market. Same with public companies, right? So we've launched Pulse, which is our B2B offering, and where we basically help public companies interact or like engage with retail investors. And so they can host town halls on the app where like, CEO can go on and do a Q&A session. They can distribute materials, around their earnings calls, for example, because also they actually have a responsibility to ensure that all their shareholders get the same information. And in the past, it has been very hard for companies to even treat retail the same way because, you might have a call with, some bank analyst, that no one else has access to. And that same thing is not happening for retail necessarily. And so there is even an obligation for public companies to ensure there's fairness in how they distribute information. And that is going actually like pretty well now already. And it's a, very lean team. We kind of call it like it's like a startup within the startup, so to say. But that is like one of the first executions of that network, so to say. And so what we, again, think about is like, first you build that base and like drive the TAM expansion. The closer you get to the reality, the more business opportunities will unveil itself that we obviously want to tap into as well.
So you're going global, but I guess what I meant was you're building in New York City. Does that mean this is the fintech capital of the world?
We also have an office in Copenhagen.
All right.
Maybe. Maybe. Who knows? I mean, New York obviously has like a deep-rooted history in, finance in general and so on. But, for us, we were here. We love New York. That's why it started here. But I wouldn't necessarily say that New York was picked because of that reason. But generally speaking, as we go global, like we will keep building our global footprint as well, right? So think we have like 40 people in Copenhagen now.
All right.
And so on. So I would say we have a pretty decent footprint in Europe already.
And so, like, we're talking on a Tuesday after like a 5-day madness sprint with Silicon Valley Bank going under and just a lot of stress in the system. What was your experience? Did you have a good weekend?
Everyone was glued to Twitter through the weekend.
Yes.
And for us, it wasn't a massive impact really. So it didn't really affect us much. I would say though, I am incredibly impressed with the FDIC. I think it's easy to always look down upon on, government institutions and the pace they, operate with and so on. But I mean, FDIC was incredibly fast here. It was, I'm just incredibly impressed by just like the pace that has moved. And generally speaking, I feel like that hopefully should give everyone, good confidence in just like, the American financial system there, because that was really what was really the risk here, right? That you just have something that you have a situation where just general confidence starts to break. And that's just something that obviously cannot happen. And so I would say kudos to the FDIC for like how incredibly quick they've, operated here.
Yeah, me too. It's like a SWAT team. And I think most people in the US don't understand this, but this wouldn't happen in another country. Like there's a handful of countries where the FDIC equivalent could act so quickly and the government would move so quickly, although it felt like, many, many days for people who were in it. But in reality, it was just 50 hours or something from start to finish. So I'm with you. I was very, very impressed. And so, Leif, as I mentioned before we go, we have quite a good number of founders tuning in or aspiring founders. What are some reflections that you usually share? Because I know you mentor and you're always open to chat with founders. What are some of the topics that you usually talk about that you could share here?
Oh, it's a super broad question, but like my background is mostly in growth. And so that's what I can nerd out about and what I have a lot of, strong point of view, as you can say. And so that's why I mostly, let's say like, have very nerdy conversations about and so on. I mean, from that perspective, like one thing that we've talked about a lot within public, and just like the way we always thought about building the company and the brand and stuff is this notion of building a fan base, not just a user base. And where a user base is basically people using your features. They're using your app for a certain utility, but you also have the risk that as soon as someone, makes it freer than free or is the cool new app around the block or so on, that those people will leave. Because it's basically, you're just coming from, like your connection is just the utility it provides. Versus the fan base really is the sense where you have people rally behind the company. And in order to get people to rally behind the company, you have to run a company that can act on its values. So it's not just words you're putting out, but it's basically like actions that you do as a company that people can rally behind. For us, for example, the decision to go off payment for order flow, literally shortly after the GameStop scenario, was one of the things we always had contemplated. And as we then did it, and, we've received a lot of user love from that. And that is one of those examples where you kind of, give your customers, basically talking points that makes it easy for them to rally behind you, because it's not just hitting the brain, it's also hitting the heart, right? It's not just like, it's the things where there's a higher calling here of like fair and transparent markets. There's a notion of they're on my side, and, and just like finding your opportunities to not just talk about what your values are, but to actually prove them. That's, I think, is one of the, most important pieces to truly build a fan base. Because if you do that, you create something that I call emotional retention. And I think emotional retention is the retention that is the most sticky, the hardest one to compete with, because you can have retention just based off your utility and your features you provide. That's fine, that's good, and like, if that's good retention, like go for it. But emotional retention is the one where you're not just with the company because of the utility, you're with the company because of the emotional connection, the emotional bond that you have with the company. And then it's just incredibly hard to compete with. And so, in our case, we meet each other in the bar and, you're using a particular green investing app, let's say, my reaction shouldn't just be, I use public. It's a cleaner experience. I kind of like the UI a little more. My reaction should be like, yo, what the fuck? Why are you using this? You should use public because boom, 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 boom. Right? And those bullet points, like that is the ammunition you give to people to rally on your behalf. And I think that is, one of the things that from a pure growth perspective, in terms of building a fan base, which then comes with all the good things, emotional retention, high word of mouth, et cetera, that's something I would always just focus on, and I would look for opportunities, because throughout the lifetime of your company, it's just like, if you are very clear of what your values there are, you will find opportunities on how to prove those values, right? And so if one value of yours is like, we always want to be on the side of our customer, or we want to always act with a lot of transparency, right? That sounds very vague and blah, but now it's on you to find moments in, the life of your company where you can actually prove that. And those actions are the ones that will build your fan base and therefore build that emotional retention.
I love that. And are there ways to measure this?
It's tough, man. It's tough, right? I mean, obviously, hopefully you have good retention. Otherwise, my whole spiel right now will break down quickly. And obviously also high, amounts of organic and so on. But I think the other thing is then also just like the anecdotes like that. Like, do you actually have people ready for you, right? Do you have people go into Twitter threads and defend you as a company, or, tell other people they should stop doing this and they should go to your company? And so, like, do you see those anecdotes or not?
Twitter helps.
Twitter helps.
All right. Well, Leif, amazing conversation. Thanks for this. I'm sure the audience is going to be very, very interesting in every minute of it. So, I'm excited to polish it. But thanks again for welcoming me to your office.
Cool. Awesome. Thanks.
Thanks for tuning in, and I hope you enjoyed this great episode with Leif Abraham from public.com. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. And if you have any suggestions or thoughts about the show, please just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza.